Hi, Ted.
Hey, how you doing?
I'm good. I'm
Good.
good. I was just about to call Sam. I was like, am I doing this solo?
Better not. I know he just reminded me, so I'm sure he's on his way.
Okay. Yeah, no worries.
How many do we think we're going to get on this call?
I don't know.
All
Hopefully
right.
about the same as what we normally get on a Monday night webinar. So it's like a
Okay.
2.0 of what we did. What was that, 2 months ago?
Yeah, right.
Yeah.
Yeah. No, this should be good. I don't know
Yeah.
if condos will scare people off or bore them, but
Well,
it's
I
good
hope that
information.
they show up because I've already had two people this week call me about condos, like in
Oh, good.
HOAs and stuff like that. It's like, guys,
Good. And we have some super nerds joining us, so
oh,
we'll get
good.
all the
Cool.
questions answered.
And I've got you don't need to worry about managing the people. I've got that. So
Okay.
no
Awesome.
stress.
Perfect. You guys staying busy?
We're trying to. Oh my gosh, it
Yeah.
was busy over the weekend.
Yeah, it seems like at least on our end, it's through the weekend and then on the fringes of Mondays and Fridays, and it kind of dies down a little bit during the week
I
on
know.
our side at least.
Rochelle and I always joke because we have these Monday night webinars that we do every Monday, right?
Yeah,
And we've done them since 2013, so we can't change it now.
right. Yeah,
So we were like,
right. Like the
why did
worst
we choose
possible day.
Monday? Oh
Yeah.
yeah, I know. She's like, I look haggard like Monday night. And I'm like, well, I know it's like you get beat up all day.
Yeah,
So it's just kind of funny.
you got to get it in there.
And who's the gentleman that's going to be joining us? Do you know his name?
I think there might be two of them. Sam Chazanaw is the head of our whole condo department, and then I
Okay.
want to say, let's see, a guy named
I just want to
Lee.
make sure when I see their names, I'll let them in.
Yeah,
So
there was some back and forth about a second guy that might Westwood, I want to say is his last name, but
okay, that's fine.
completely butchering that. Hang on, I should know. Hold on. Sorry, Westcott. So Ian Westcott. So Sam
Westcott.
Chazanaw and potentially Ian Westcott.
Okay, perfect. There's Sam. Hi, Sam.
Hello. Hey, Ted.
Hey,
You gonna catch your breath on that rescue loan for a minute?
yeah. So I was just sending a text off to the guy to calm him down.
All these crazy people.
So
Yeah.
that lead you sent me, with that young couple that wanted to zero down, they communicate with me like once a week, but it's gonna be kind of a long-term project.
Which one is that?
Oh, I'm talking to Shannon.
Oh, okay.
Oh,
All right. I was
which
like,
one?
what?
I thought you were talking to Ted.
No, sorry.
Me too.
I sent to I don't know if you've got her information, Sam, but Myung Williams, she's a newer agent to Best Choice, and she's wanting to touch base with you to see whether or not she can even buy a house this next year.
Okay, I don't think I've heard from her.
I just gave her your
Okay.
business card today. Yeah.
Thank you.
Yep. Okay. Are we good to let him in? Or I guess there's Sam. I'll let him get situated first.
Yeah, it's a good idea.
Yeah. And looks like Randy. I don't think that's your Randy.
No.
There might be also Ian Westcott, who is also a manager,
Yeah,
Might be popping
I
in.
let Shannon know.
Okay. Hi, Sam. Chaznov. Looks like he's got his video and his audio connected. Okay, so I've got looks like around 17 people in the waiting room. So I'm hoping, Sam, can you check your audio? Just make sure it works.
Yeah,
there you
can you hear me now?
Yeah,
Yep.
perfect.
Okay, can you see me?
Yeah, I can see you.
Great.
Thank you.
Hey, Sam.
Hey, guys.
Hey.
Welcome.
So my name is Shannon. I'm with Best Choice Realty. I'm the operations manager for our firm. So I'm gonna just go ahead and introduce. If you're good, Sam, Ted, hopefully we'll do it similar, Ted, like we did a couple months ago. It's kind of open discussion. And then we kind of like to lead the first, if you guys have something you want to present, do you need presenter rights, Sam, Ted? Sam? I got two Sam.
Not really. This is going to be
Okay.
more of a discussion. We're going to be talking a little bit about how movement can help your realtors do more condo business.
Okay.
What separates us from other companies, our processes, and just a little background like that. And there's, hopefully there'll be some good questions and discussions between Ted and Sam and the audience.
Okay.
This can be a little tricky.
Perfect. So it's like open Q&A kind of thing, open discussion.
Sam, if Sam Sentioli, if you want to do the sort of intro, that'd be great, because I'm kind of straight from the frying pan into the fire right now. So I'll let you lead it off.
No worries. I'll introduce you all. So no worries there.
Okay.
Okay, I'm gonna let him in.
There is really, I don't think anyone believes Vladimir Putin is discouraged.
Thanks for popping on, you guys. We're just gonna give it about one more minute so people can get their audio situated.
For the new leaders position themselves with their allies in Europe and in the United States in denouncing moving trends for you.
Okay, you gotta go to mute. Mute.
Perfect. Well, cool. Well, great. Thanks for everybody who's popping on. My name is Shannon. I'm the operations manager for Best Choice Realty. And today we've got a special treat. We've got like a trio of a lending company here to kind of help and guide us and give us some direction and insight, at least on their side of the business. So we've got Ted Buchanan and Sam Sentioli, who are from Movement Mortgage. And we also have Sam Chaznov.
Yes, perfect.
Okay, I was like, I don't want to mispronounce it. And he is over basically anything to do with HOA. He is like our little guru that's here to join us today. So we just kind of have on deck, we just wanted to have an open conversation with all of you guys. So if you guys want to pipe in, just go ahead and *6 to unmute, or just unmute your line if you want to pipe in, ask a question. We certainly have the experts here that we can get our questions answered as we're navigating some of these condos. I know from at least my perspective, we're seeing a lot more condo sales, condo listings coming through our office's transactions. So I think part of it has something to do with affordability of a lot of first-time home buyers that are buying these condos. So we want to make sure that we don't have issues once we're under contract or even before we've even listed the property. So I'm going to let Sam, if you don't mind, just kind of giving us an introduction as to our other Sam. We've got two Sams, Sam Sentioli and Sam, who's our HOA kind of guru. So go for it, Sam, if you don't mind.
Sure. Just to give you a little background, my name's Sam Chaznov, and I oversee condo production nationwide for Movement Mortgage. Been in mortgage banking now for over 30 years. And I actually engineered the design of Movement's condo department 8 years ago. Over the last 8 years, my team and I have approved over 30,000 condo projects for Fannie and Freddie financing. And what's really interesting about that, most of the projects that we got approved were approved even before our buyers had ratified contracts. So they knew going into the offer phase that there was not going to be any issues, that that project would be eligible for the same type of financing that they were qualified on the credit side. And today we're just going to be talking a little bit about what Movement does to help more condo business, whether you're on the listing side or whether you're on the buyer side. We have some processes that may help you do more business. And that's what this is all about today. If you're involved in a condominium transaction and there's financing involved, it doesn't matter how well qualified your buyer is. If there's an issue with the warrantability with that project, you're going to run into issues finding out if that deal is going to close or not. If anybody has had experience with condos, most companies wait until midway or towards the end of the transaction to start that process. At Movement, we do things a little differently. We have the ability to approve condo projects internally for both Fannie and Freddie. And when we approve projects, we can do it quickly, usually within 24 to 48 hours of receipt of the core documents. And once we issue an approval, that approval for an established project is valid for 12 months. So during that 12-month period, your future buyers will never have to worry about waiting for condo docs, paying for condo docs. They'll be able to utilize our approval during that period of time. And that's very important because not only will you get a letter stating that your buyer is credit approved upfront from Ted and his team, but Ted can also get you a letter from my department stating that we have that project approved. So if you're in a market where you have very tight inventory and you have multiple offers, this will hopefully give your buyers an edge in that bidding war, knowing that we have this project approved up front. Any questions on that piece? Good information?
Yeah, so I think, are you, at least from your perspective, Sam, are you seeing a lot more condo units being built and developed as well?
Absolutely, and that's because we're running out of land in all urban areas. We have to go vertical. We're going vertical. We're seeing tear downs. And when you talk about going vertical, vertical property regimes, you're talking about, in most cases, condominiums. Vertical property regimes are common interest communities. We have apartment complexes, we have condominiums, and we also have cooperatives. We don't see too many cooperatives in your part of the country. They're mainly in New York, New Jersey, and they're scattered in other states. So predominantly we see apartment complexes and we see condominiums. But understanding warrantability, and let me just tell you, warrantability is a big mortgage banking term that we have. All that really means is that loan sellable, okay? Warrantability means if you're dealing with a veteran and they want to use their VA financing, we have to make sure that that project is warrantable to VA. If they're dealing with an FHA buyer, either going for a first-time buyer or maybe somebody that's looking for a reverse mortgage, we have to make sure that that project is warrantable to FHA guidelines. And if you have a buyer that's looking to buy an owner-occupied second home or investor, then we're looking at Fannie and Freddie guidelines. And Fannie and Freddie guidelines hold true for most of our jumbo investors as well. most of the jumbo investors that we have internally require the project to meet either Fannie or Freddie guidelines. And at Movement, we have the ability to approve projects quickly and efficiently. Now, one thing that's important for everybody to know, and a lot of realtors may not be aware of this, is that condominium financing varies from lender to lender. Condominium financing varies from lender to lender because a lot of lenders can deem a project as being non-warrantable at their lender level. They can take agency guidelines and make them more restrictive. Is everybody aware of that? Did you know you could have a buyer that's qualified for $500,000 mortgage and be shopping with 3 or 4 or 5 different lenders, and each lender can have their own set of guidelines more restrictive than Fannie and Freddie. And in many cases, you won't know about that until they go through the condominium process. Anybody surprised by that? Okay. The most common lender, we call this overlay or lender rule, is by putting a restriction on the number of investors in a project. Anybody hear that? This project is not warrantable by this lender because you have 40% investors or 50% investors, and so on and so forth. Anybody here that or have a problem because of the number of investors in a project?
I've got a chat. They're asking if you're referring to the rental cap.
Yes.
Yeah.
Yes. Who would be
Yes.
surprised if I told you Fannie and Freddie have absolutely no rental cap if your buyer is an owner-occupied or second home buyer? Would anyone be surprised by that? That is the number one reason we see loans being denied by other lenders and coming into Movement. And Ted and his team and our other teams across the country are able to turn those around, because neither Fannie or Freddie have a restriction like that, but a lot of lenders will cap that internally. As long as their rules are not less restrictive than Fannie and Freddie, but are more restrictive and are applied in a non-discriminatory manner, that's acceptable. And a lot of realtors are not aware of that. The second most common lender-imposed rule that we see is regarding litigation. We have a lot of lenders out there that will absolutely not lend in a condominium project if there's any type of litigation. Years ago, during the downturn around 2008, 2009, 2010, litigation was a really big issue. And both Fannie and Freddie had a no litigation. But since then, they've eliminated that. We have our own staff attorney, and we could handle almost any type of litigation in a condominium project, as long as that litigation is being represented by the insurance company providing the insurance for the HOA, and the litigation does not involve health, safety, or habitability issues. And I got to tell you, we get deals being denied all over the country on a monthly basis, usually towards the end of the transaction, because that's when most lenders start the condominium review process, and they get that condo questionnaire and the box is checked, yes, there is a litigation. So at Movement, we wanted to make sure that your buyers know upfront that the project is warrantable. And I'll tell you why. In Washington State, you have thousands of condo projects, okay? You have thousands of condo projects. VA has a list of over 2,600 projects that are already approved. So if you're dealing with a veteran and they want to buy in one of those projects, all we need to do is have a well-qualified veteran and get insurance for the project, okay? VA condos are probably one of the easiest condo loans you'll ever do. FHA, on the other hand, FHA has 676 approved projects currently, okay? But they also have over 1,500 projects that were previously approved, but had expired. Unlike VA, when we get a project approved by VA, there's no expiration. It's on the list indefinitely. But with FHA, when we get the project approved, it was approved for 2 years. Now they've extended it to 3 years. But if the HOA does not request that project to be recertified, it expires. And you lose all that opportunity on projects that were reviewed, that met all the legal doc requirements, that met the budgetary requirements and insurance, simply because the HOA did not go through that recertification process. When we talk about conventional financing, owner-occupied second home and investor, in the whole state of Washington, Fannie Mae only has 37 projects on their approved list. 37 in the whole state of Washington. Freddie Mac has 0. Not only does Freddie Mac have no projects approved in Washington, they don't have a list of approved projects in any state. And that's by design. That's because both Fannie and Freddie want the individual lenders to determine if they want to lend in that particular project. And that's where the biggest issues are. And that's why condominium financing can vary so much from lender to lender, because of these lender imposed rules. At Movement, my team and I have approved over 700 projects in the state of Washington. So we have an extensive database. We understand the way the Washington market works. We understand Washington condominium laws. And our team is here to help you understand if the projects are warrantable. And here's how it works. If you have a buyer that wants to buy a condo, and you have Ted or a member of his team pre-approve them, once they get pre-approved and they want to set up listing appointments to go see units, if you give Ted 3 pieces of information on that listing, you give him the name of the project, the address of the project, and the HOA contact information. Name, address, and HOA contact. He'll contact my department and we'll check our database. We'll see if we have that project already in our approved database, or if we have any information about that project right up front. If we don't have that project approved, and if that project is not already approved by FHA, and I say FHA because FHA now has an arrangement with both Fannie Mae and Freddie Mac for reciprocity. If FHA approved the project, we can now use that FHA approval for owner-occupied, second home, and investment properties, saving you time and money, taking the uncertainty out of the transaction. If that project is not approved, that's when my team will step up and will reach out to the association. We will request the docs. And in most cases, most associations and management companies will give us whatever docs we need as long as there's an active listing in the project, and we're willing to pay for the condo doc fees. And that's the commitment Movement Mortgage has made to the condominium space. Movement wants to be the #1 condo lender in all of our markets. So we will make that investment into the data for the project upfront, as long as we have a qualified buyer and there's an active listing. And our promise is within 24 to 48 hours of receipt of those documents, we'll let you know if that project is warrantable or not. Now, if we get that project approved, if you're a buyer's agent, you'll receive a letter that you can submit with your offer to help have your buyer have an edge against other competitive bids. If you're a listing agent, you can now let potential sellers in that building know that your lender has that project approved. So if that seller lists with you, you can advertise that as being eligible for financing through Movement Mortgage. Make sense?
Thanks, Sam.
Any questions?
Yeah, so I guess a question for Sam and Ted is how often are you seeing that this is, I mean, A, that we're encountering issues and B, where we're having these approvals actually be a huge benefit? I mean, what are we kind of seeing in actually, some real world scenarios kind of thing?
Okay, let me tell you, when I started, when I was given the task to build the department, we were doing about $20 million a month in condos. We're now doing on average $200 million a month in condos. And the nice thing for the potential buyers are, they do not have to pay for condo docs unless we get the project approved and they choose to go with us. Otherwise, it's our investment into the data. And that's what we do for the buyers. So this has helped our buyers have very good experiences and help generate referrals for their family, friends, and coworkers. And I originated for 25 years before I went onto the ops side. So I know not only is closing the deal at hand important, but getting referrals from the transaction. So the founders and senior management at Movement gave me the ability to build this out from a loan officer's optics to make the process easy for our realtors, for our borrowers, as well as for our loan officers. My team does all the heavy lifting. We don't want you guys running around trying to get questionnaires or budgets or insurance. I have a whole team that will do that. And we will do that up front for you. Not only will we do that for conventional financing, but if you have a veteran and they would like to get that project approved by VA or FHA, our team will sponsor and work with the HOA at absolutely no cost to get these projects government approved for your sellers, for your buyers, and for your builder partners.
Thanks, Sam. And it looks like we had a question. If you don't mind clarifying, we were talking about investors for the HOA. Are you referring to actual rentals or investors in the HOA? Looks like a couple agents were confused.
Okay, let's talk about both. Occupancy. You have three types of occupancy. You've got owner occupied, you got second home, and you have investor. Okay.
Same as rental, right? Yeah.
Yeah, well, yeah, and rental could be defined as short-term rental or long-term investor. But let's assume for our conversation, we're talking somebody who has no intention of occupying the unit as their owner-occupied or second home. They're buying it strictly as an investor, and they may own multiple units in the project. Okay? Fannie Mae has certain rules regarding that. As far as investors, the number of renters in a project, there is no restriction on the number of renters as long as the buyer is owner occupied or second home. Okay. A lot of lenders will cap the number of investors in a project. And we see it commonly starting out at 40% and going up to about 50%. Both Fannie Mae and Freddie Mac have a rule regarding the number of renters in a project if your buyer is a renter. If you already have 50% renters in that project, then the buyer would have to put 25% down and go limited review. Once we go limited review, then we can exceed that 50% cap. We commonly see 60, 70, 80% renters in a project, and we can still finance additional renters in that project for investment buyers, as long as they're putting 25% down. Florida, you need 30%, but in Washington, it's 25.
And then really quick, Shannon, your original question is how often do you see this actually executed? Do I see this executed by either listing agents or buyer's agents? Practically never. So it's a really good way to ensure as a listing agent that your transaction is going to close successfully and you don't have a bunch of mud on your hands due to the fact that you didn't take advantage of a free program up front. And you find out that the lender that's handling the financing for the buyer last minute, you have the deal flip, it makes you look terrible versus just a quick phone call to Samurai. We collect the information you need. You know that you have either a primary source of lending, hopefully, or a backup plan if the financing falls apart. But we never see it. Listing agents rarely ever take advantage of it. I don't know if it's laziness or intimidation or what it is, but it rarely happens. So everybody on the call, if you're listing a new condo, reach out to us.
Perfect. Thank you, Sam. Thank you, Ted. And I had a question. I mean, we're getting kind of random stuff that's coming through to me privately. So thank you for you guys that are sending stuff through the chat. You're welcome just to send your questions about condos through us. We certainly have the experts here. But it looks like some people were asking about these are the lit assessments going to affect financing in some way for the deal? That's basically the summary of the question.
Special assessments?
Yes. I'm assuming siding, roofing, that sort of thing.
Oh, okay. And that's a great point. I'm sure everyone has heard about the tragedy in Surfside with Champlain Towers, okay, where the building collapsed and many people were innocently killed in their sleep. In reaction to that tragedy, both Fannie and Freddie have imposed some additional rules. And now we as lenders need to review special assessments. Special assessments are okay, and they're common as long as they're for proactive work. However, if the association has been cited by a local jurisdiction or an inspector for a local jurisdiction for health, safety, habitability issues that should have been maintained but has not been maintained, and they're getting a special assessment for that, then you're going to run into a problem, okay? In those cases, they want to make sure that if they were cited for health, safety, habitability issues, that the work has been completed and that those issues are no longer present in that building. If somebody is, in Florida, I'll use Florida as a good example. We have a hurricane and they have damage from the hurricane, unexpected damage, and they need to do some repairs as a result of that, maybe to the siding, maybe to the roof, etc. In those cases, they're responding to the issues from the hurricane. That would not be a deal killer, but we would want to see that any structural damage has been mitigated so it doesn't adversely impact the owners of the condominium. Now, just so you know, this has been something we have always done whenever we've submitted a project for FHA or VA. They have always been concerned if there is a special assessment. One, does it impact the buyer's affordability? And two, is a special assessment for sins of the past, for maintenance that was not done, and now they have to catch up and they're being reactive to the local jurisdiction. Proactive is fine, reactive is where we run into problems.
Right. So it's kind of like proactively asking sellers, what type of assessments do we have going on the property? Do we have a roof that's coming up? I know I had a listing about a year ago where it was a condo over in West Seattle and they had a siding, and it's expensive. It's not cheap. It is an assessment, and it did encourage some people to want to sell their properties. So knowing it proactively, we can certainly address it with financing.
Right, and you're probably going to see more lenders asking for the last minutes, for the last two meeting minutes. Fannie Mae has recommended that as best practices to see if there's any mention of any deferred maintenance or any pending structural defect issues. Our policy at Movement is pretty simple. We ask for it. If it's available, we review it. If it's not available or the HOA is not willing to provide it, we don't use that as a reason to hold up the review process, because it's not a requirement, it's only a suggested best practice. They started this last fall, and I got to tell you, most associations are very cooperative with this. So it hasn't created any issues or any delays for us for the most part.
Hey, Sam, can you talk about a little bit about single-use approvals for FHA?
Yeah, FHA has something called single unit approval, the SUA. Years ago, we had something called spot approvals, okay? But they came back out with something called the single unit approval. And there's a lot of misconceptions about it. But basically what it is if you have a project, an established project with 5 units or more, where the current FHA concentration, that means the number of FHA loans in the project is under 10%, and it's an established project, we have the ability to review the project at our office, at the lender level. Typically, we gather all the docs with the cooperative HOA, we review it and send it off to HUD. And it usually takes about 4 to 6 weeks. But for projects that meet the parameters of the single unit approval, we need all the same documents for the whole project, but we save you 4 to 6 weeks by being able to turn it around usually in about 48 hours. So that's a nice feature. And I would say Washington is ideal for that because you've got over 1,500 projects that were previously approved by HUD. In those projects, if the FHA concentration is under 10% and there's been no major amendments to their documents, those projects should fly right through for single unit approvals. And that's what I encourage all my LOs to do in various markets.
I've got a question that came in. Thank you for asking this question. One of our agents was asking about, and I'm sure this is coming up too with even like HOA fees and whatnot, similar to when people are not paying their mortgages over the last couple of years. What about residents that have not paid their HOA dues for a while? Is there some sort of special assessment that covers their payments? How does that end up working out during the course of escrow, or even ahead of time if you're to prep for something like that?
Okay, different rules for different agencies. Let's talk Fannie and Freddie first, okay? If you have a buyer that's looking to buy an established project and they're putting less than 10% down for owner occupied, less than 10% down, it's a high LTV loan. In those cases, we need to rep and warrant to Fannie and Freddie that less than 15% of the unit owners are 60-day or more delinquent, okay? 15% of the unit owners, 60-day or more delinquent on their actual HOA fees, okay? If they're putting more than 10%, 10% or more, and it's an established project, we can go limited review, and that's not an issue. VA, if the project is already VA approved, that's not an issue. FHA, we have to rep and warrant that on every loan we do for FHA, even if the project is already on the FHA approved list. So there should not be special assessments for that. There may be litigation, foreclosure procedures if they get too far out on their liens, but that should not adversely impact the HOA. If you have a high percentage of investors or renters or even unit owners that are going through financial stress, then you can run into budgetary issues. But the last time I personally saw that was in the 2008, 9, and 10 periods.
Hopefully that answered your question. Another question that I'm sure we've got, and this might be for Ted and Sam Sentioli as well, but in terms of how can we, as an agent, what are some of the things that we should look for that are causing you guys to deny potentially communities, and has that even happened, to deny communities for Fannie, Freddie, that sort of thing?
Well, yeah, you want to take that, Ted?
Well, yeah, it's the other Sam can take the deny part, but I just want to make a comment about what the best thing you can do to help us is when you submit the purchase and sale to us, make sure we have a good condo contact, because Sam mentioned that they're approving these condos in 24 to 48 hours after they get the paperwork. But to get that paperwork can take 3 weeks if we don't have the right condo contact or they don't respond. So it's a lot of times everyone's busy and we'll just scrape a name and email off a website for our condo complex, and it's old or it's not being monitored. So and even better is make sure we have a good contact and that you actually reach out to them and say, hey, Movement's going to be reaching out to you. If you could please get back to them as soon as possible, because we could potentially have a condo approved really quickly, but the bottleneck is getting a hold of and getting information back from the person at the condo.
I agree with you 100%. That's the one piece that we cannot control. How long it's going to take for the HOA to provide us with the documents. Some HOAs use management companies where we can just go online, use our company credit card, and have the docs instantaneously. Others require us to submit a check and they'll send it to us when they're ready. Couple of things that we do that other lenders don't is we can actually work with a president, vice president, or treasurer. So if the seller has contacts of an officer of the HOA and that HOA officer is willing to provide the information to my team, we'll set up a phone conference with them and complete the information over the phone and have it done instantaneously. But again, those are situations where we have cooperative HOAs and officers. Also, if you have a deal that's going sideways with another lender and you have a questionnaire, budget, and insurance, send those up to us. We'll review those and give you a second opinion, usually same day or within 24 hours at the latest.
And I'm sure, I know Sam has taken some of those, right, Sam? We call them the savior deals.
The rescue deals, yes.
Yeah.
Sam, what percentage of condos end up not getting approved? Just ballpark.
Well, very few now, and I'll tell you why. Because we have true agency warrantable products, but we also have our internal non-warrantable products. For instance, if you're working with a condotel, a true condotel, we can do condotels up to $5 million, where they can have reservation desks, they can have on-site rentals, daily rentals. We can do first money in on new construction projects that agencies, Fannie and Freddie, require 50% of the units to be sold or under contract to owner occupied. We have products that don't require that. We can do the first units in. They can even be investor units for the builder developer. We have products that will allow single entities to own up to 50% of the units in the project. So we may not be able to go the warrantable route, but in many cases, we can offer a non-warrantable, non-agency option. Now, true deal killers are construction defect litigation that involve health, safety, habitability issues. where the work has not been done. None of our products will allow financing for that. So that's an automatic deal killer right there. If we go into a non-agency product, we want to make sure that there's proper fidelity insurance, that money is being set aside for capital improvements and maintenance on the project. So if you have a project that doesn't meet agency guidelines and they don't have any money being set aside for maintenance and capital improvements, that will be a deal killer as well.
Looks like, thank you, Sam, for answering that. And then Lori, great question. How punitive are the rates for non-warrantable projects? What are we kind of seeing?
Well, there are a number of, and we have some in-house investors, and then we have options to broker as well. And that can vary, and a lot of them are case by case, but I would say fairly punitive. And I guess it depends on the reason for the non-warrantability, because even investors that claim they'll do non-warrantable condos definitely have a line in the sand. Certain issues just aren't financeable at all. So it's hard to answer that question. And I guess it would depend on the quality of the buyer's credit file as well. But, you know, I guess to generalize, at least 0.5% in rate, if not more. And that would be for, you know, maybe a smaller indiscretion that doesn't work for Fannie, Freddie, FHA, or VA, and we have a very strong credit file with, you know, excellent credit and it's owner occupied. I don't know if that answers the question or not.
Yeah, I would say 0.5 point to a point in rate, which is better than you're going to get with a hard money, you know, lender or one of those portfolio lenders. So it's definitely worse, but quicker and better than the alternatives.
Right, and I will say at Movement, our internal products offer fixed rates, hard fixed rates, where most of the larger national lenders that work on a brokerage basis offer like 3.1, 5.1, 7.1 ARMs. So it's an alternative. It's a better alternative than a lot of our competitors out there, but it will be higher than agency because of the risk that's involved on non-warrantable paper.
And then I guess just a overall question, this could be for mainly you, Sam, I think, but what are we kind of seeing from, you know, a national standpoint that you think might impact our local kind of Seattle, Puget Sound kind of area for the most part? I know that there has been some changes in Seattle assessments, things like that. Is there anything that we need to kind of keep in mind of as we go into, you know, the rest of the year as it pertains to condos?
Yeah. From my perspective, I will tell you, because I attend all of the agencies' conferences, and I'm also on pilot programs with both Fannie and Freddie currently. Fannie and Freddie understand the importance of condominiums. They understand the affordability factor, the lifestyle factor, and the fact that there's limitations on land, that they have to use the airspace. So they are trying hard to make condominium financing easier. But one of the biggest challenges is the fact that they allow lenders to make the determination if they want to lend in a project or not. And those lenders can take the agency rules and make them more restrictive. And that's what can make condominium financing so frustrating, and why condominium financing can be perceived as a real headache. I know when I originated, if that borrower wanted to buy in a project that was VA approved or FHA approved or on the Fannie list, it would be no issue. But if it wasn't on the list, there was a very good chance that that deal was not going to go through. And you always have your reputation risk. You have your sellers that are looking at multiple offers. And what I see is that the agencies are working hard to make it easier. Companies such as Movement are investing into the condo data and the processes to help provide certainty. We want to take the risk out of the condominium transaction, so you know up front and your realtors know up front that this deal is going to get to the closing. or if there's an issue, it's not going to be condo related. Does that help?
Yeah, so it's going to be easier for these first time home buyers, hopefully, to get into some of these properties, these complexes.
Oh, absolutely, because FHA requires 3.5% down. We do 3% down financing. And I'm not sure if you have any USDA approved areas where you have condos, but USDA condo financing is very big. And we do a lot of zero down condo financing utilizing the USDA program.
So I've got a question that there's a, can you talk a little bit about when an HO6, walls in policy is needed and what that is and how it's different for some of the agents that don't do a lot of condos?
Yeah, great question. The Master Association, the HOA, typically has a policy that covers the structure, because what the buyer purchases is actually the airspace. When somebody buys a single family home, the collateral is the land, the interior, the exterior. You can assess the risks on that. But when somebody buys a condominium, they're buying the airspace within the unit. Some policies by the HOA will cover not only the exterior, but also the walls in, including any betterments and improvements that the buyer has made. In those cases, no HO6 policy is required by the buyer. If the HOA only has a master policy and no walls in coverage, then the unit owner needs to get coverage to cover the interior of the unit. Now, some lenders will just put an arbitrary limit. We want that HO6 policy to be 20% of the purchase price or appraised value. We don't do that. The agencies don't allow that because lenders are not permitted to have buyers purchase more insurance than what's actually required. So both Fannie and Freddie, VA and FHA have adopted the rule that the amount of the HO6 should be determined by a conversation between the borrower and their insurance agent. And there's no right answer and there's no wrong answer. Anybody surprised by that?
I learned something today. Did not know that.
Well, years ago, it was the 20% rule, but now if you only need maybe 10% or 5%, the lender cannot impose that restriction. Otherwise, they're in violation of new rules through Dodd-Frank. So yeah, it's just within the last several years.
Do you know what percentage are covering walls in? It seems like I would guess a third, but you have a bigger.
Very few. I mean, we'll see walls in to builder's original specs. That's the most common walls in that we'll see. So if the unit owner added betterments and improvements, it won't cover that, and they'll have to get their own HO6. But we don't even, as the head of the condo department, we don't even have that as a condition. We pass that on to the credit side because it's a pass or fail. There's no actual amount that needs to be presented on that. So we will approve the project at the project level, and for loan level approval, all we want to do is make sure that we have the appraisal in. The borrower's HO6 is just an arbitrary amount that's determined, and we let the credit underwriters sign off on that.
I think a lot of the things that Sam has taught us today is that approval of a condo, given the guidelines, can be very arbitrary from lender to lender. So just be sure to do your research. And I will pat Sam on the back. We've had several of these condominiums come up with assessments where the recent issue stemming from the disaster in Florida came up, and it's definitely a very subjective process moving through that. Fannie Mae and Freddie Mac literally gave us a one-page document for guidance, and Sam, you can correct me if I'm wrong. And lenders could read through that same document and come to different conclusions. And I will say that, it's all recent for all of us to pick up and deal with that. But now that we're digging into every assessment, Sam and his team have really been awesome to try to make that deal work if we possibly can, because when we're dealing with health and safety issues and structural problems, there's definitely some interpretation that has to be made. And Sam's been great helping us through at least a handful of these so far. And I think that's going to be a new trend that you're going to see with assessments, because typically something needs to be fixed on the condo, and one lender might decide that it's a health and safety issue and another one may not.
Yeah, I think for new agents, I mean, we tell people, we're like, don't be scared of condos. They think that it's scary, and it doesn't need to be. It can be a lot simpler than you think. I think it's just making sure you've got especially the right lender if you're representing the seller, to making sure that that loan will actually go through. I know that we've been in circumstances where they have to switch lenders. I know, Sam, I think you've taken a couple rescue deals for especially condos, and they can be very tricky, but having the right information from the get-go, I think is important. So cool. Is there any other questions? If you've got questions, star 6 to unmute, or just send something through the chat or unmute your line. We're happy to get your questions answered about condos. We do a lot of them here. We even have, I think we were the #1 seller at Insignia downtown when they were being built. And I know the ones down in Bellevue too. So, I mean, we're doing a lot of condos here at Best Choice. And I know a lot of our newer agents, don't be scared of them. A lot of our experienced agents, your mentors, are happy to help if you've got questions as well after the fact.
Give us a call. We've got Sam, the super condo nerd, here to help us.
Yeah, Sam, Sentioli, and Ted, do you mind putting your contact information in the chat?
Sure.
That way they can contact you if they've got something. That would be great. And then I know, just kind of on the same train of thought as we're talking about condos, if you've got a client that is a first-time home buyer, go onto our member resources on our website. We have a kind of like a condo FAQ that's kind of helpful for those first-time home buyers that may be nervous about going into a condo or don't know what the difference is between having one on land versus actually having a condominium project. So use that as a resource. New buyers, they're craving information. I think just giving them more materials, don't overwhelm them, obviously, but giving them ways to answer their questions ahead of time is always going to be really helpful for them. And I think, thank you, Ted, Sam, for dropping that in there. I think that's all the questions that we have for today. If you've got anything, you're welcome to send Sam or Ted a message, or me after the fact. We're happy to help however we can, but thank you for popping on. I knew this was kind of a special call because we have Sam to join us. We don't always get to have special guests like him. So thank you, Sam, for joining us. I really appreciate it. And Sam and Ted as well. And then if you've got questions, again, just give us a call. We're always happy to help and making sure that we can get those deals through.
Thanks again, Sam. You're the best.
Thanks, guys.
Everybody.
Thanks, you guys.